James Shugg is a senior economist at Westpac Banking, and he joins me from his offices in the city. James, I know you were possibly disappointed about these GDP figures, but how much were you disappointed by them?
Francine, great to talk to you again. Look, in a sense we weren't disappointed because they kind of validated our view that we've held for a long time that the US economy really is going to be an underperforming economy. I think if we'd had these GDP numbers, with the Fed at least, had a forecast of these GDP numbers a year ago, they would have started QE2 perhaps earlier and done substantially more purchases than the $600 billion that they put in place. Our sense is that the economy really hit a brick wall in the first half of this year. There were some special factors at play, of course, but the underlying story, even without those special factors, we think is substantially weaker than the consensus, particularly amongst American economists, has been. And now we're starting to see some real hard evidence of that.
James, we know that the recovery was actually much deeper. We know, or the downturn was much deeper, that the recovery is much weaker. But are we risking a double dip recession at this point?
Well, I mean, just because history was revised down, it doesn't mean necessarily that the outlook is going to be that much weaker. I mean, we still think there's a chance the US economy will make growth approaching 2% this year and around 2% next year, which is not going to be enough to pull unemployment down substantially. It will still remain around 9% or higher by the end of this year, and indeed close to 9% at the end of next year. On those forecasts, I suppose maybe the risks around that forecast do have to be weighted just a little bit to the downside now. I mean, really, as you say, the extent of the recovery, it was progressively revised down more steeply through last year, and the first quarter of this year, the economy almost stalled.
James, what happens if actually we don't get a debt ceiling agreement in the next couple of days? And what happens if the U.S. loses its AAA credit rating? Is that going to put the U.S. into a recession? Because there'll just be such a huge loss of confidence out there that it will spell real trouble for the markets.
I don't think the question is, does it push it into recession? You can't say that one particular factor will. I think that there are justified reasons not to think that. I think that the US economy has gone through a process of readjustment. That process does need to be ongoing and will continue to weigh against the economy, absolutely. Whether or not it's enough of a headwind, enough of a new headwind to push the economy actually into negative for a sequence of quarters, well, that's not yet our view. But certainly, again, I hate to say it, but you've got to couch it in terms of the risks being intensified of that being the case.
But so do you actually think that the US will lose its credit rating over the next couple of months?
Look, I'm not a ratings agency. I kind of understand the logic that the agencies have been using. It's almost like they'll lose it anyway because the political process has been demonstrated to be ineffective in the US. And even if an 11th hour agreement is reached, we've now got in the minds of investors the increased risk that at some future point, we'll see this problem emerge again, and maybe it won't be soluble, even if it is temporarily solved this time around. The US really doesn't belong as a AAA when you look at the likes of Australia, for example, which is a real genuine AAA economy.
All right, James, what does it mean for countries like Japan? Because, of course, they've had so much buying of yen. Are we going to see some kind of intervention in the next couple of days because they just can't afford it to go much higher?
Look, the Bank of Japan does intervene from time to time, of course. It's not really effective unless it's a concerted intervention, and I don't know that that's with other central banks as well, other major central banks as well. So I'm not sure that they've got the case built yet for all the big guys to step in. But certainly the Bank of Japan, it wouldn't surprise me entirely, but look, I'm not a currency strategist, I'm not going to say yes or no, but certainly it's getting to the point where I suspect some people would be arguing for it very strongly.
But overall, James, if we have a look at what currencies are doing and what bonds are doing, what are you expecting next week? Treasury's pretty much not pricing in any kind of default from the US or a downgrade. Clearly there's still this hope that an 11th hour agreement is going to be reached. And I've got to say, it's my view that will happen too, although I'm an optimist, James.
Well, I mean, unfortunately, even if we were this close, but it sounded like they're moving closer together, I'd still be more confident. I'd be more confident. But the fact is, they just don't seem to have any common ground. One lot will not raise taxes, and the other lot want to protect a big chunk of spending, and never the twain shall meet, it now seems. But still, our view would be that some agreement will be reached. It would be political madness for it not to happen. This is idiotic.
It's true. Yeah.
Sorry.
They do need to come up with something. At least we hope so. James, thank you, James Shugg there.
Thanks, Francine.